All right, we're live today with Rich McDowell from Synergy One Lending. He's here again to dive a little bit deeper with us in what we can look at or what we can expect to see when we get a lending quote. So I know a lot of us, when we go get that lending quote, we're presented all these numbers and figures, and we just go, what in the world does any of this mean?
Right.
So today, Rich is here to kind of, he's going to walk through with us, present to us what it is that we'll be looking at and what all those crazy numbers mean. And so without further ado, we'll hand it over to Rich.
Well, perfect. Well, so I'll talk real quick and then I'll share my screen to go over a couple of things. So
Perfect.
The one thing I would tell you over the last several years of doing this is not all quotes are not equal.
Mm-hmm.
And I think too often people just throw a bunch of numbers together and they don't do the research with the clients. And so kind of one of our goals and what we've done with some of your clients as well, what are their financial goals? Because just getting them in the home might not always be the answer. It's like, what do you want to do with this home, 3 years from now, 5 years from now, 10 years from now? And so what we really want to do is give them a couple of different mortgage strategies. And so I'm going to share with what we typically send a client. It's going to look different than what I think most people are used to. And so I'm going to pull that up now if I can. Let me just share my screen. And let's see here. We'll share it and we'll share it again. And you should be seeing my screen at this point. And so what I'm going to do is I'm going to pull up the mortgage coach presentation. Are you seeing that?
Yes.
Okay, so this is typically what we will send to the real estate agent as well as the clients. And so they'll click here on the disclosure piece of it. And I'm going to pause this a little bit. So there's a little video that goes along with it to try to give the clients expectations of what this is, right? Because now it's going to be a lot of numbers. And so what we really try to do is give clients a couple of different strategies. For instance, because most clients want to look at, well, I heard this interest rate, or I heard this scenario, or what does this mean to me? Why should I put less or more down? And we kind of want to answer that on the front end. Mm-hmm. And so what we do here, we have strategy 1, strategy 2, strategy 3, strategy 4. So the first two strategies are just that, conventional loans, one with, I want to say 3% down. The strategy 2 is with 5% down. Mm-hmm. That gives them the conventional financing. So first time home buyer, they can get into a conventional loan with 3% down. And I'll stop kind of right there. A lot of people come to us and say, well, I don't want to go conventional because I have to put 20% down or 10% down. That's just not accurate. And so one of the things that we want to try to do is give them the options for their mortgage strategies.
Okay.
Column 3 and 4 kind of go over the government type loans. If they're a veteran, God bless them. I'm a veteran. I love doing those loans. I think they're the easiest loan out there, to be honest with you. And then the FHA loan, which is another government strategy loan that allows them to put 3.5% down. Okay. And so now they get this, and as we can all see, there's numbers from 275 to down here at the first year cost of $87,000. What in the heck does this mean, Red?
Yes.
And so what we want to do is, if you'll see up here, when you get those, you have more information. And now this gets into the payment breakdown, closing costs, reinvestment piece. So this kind of really dives into what are their goals. Is it a monthly payment? Is it a saving strategy? What is their true need on their mortgage? And so as we kind of go down through here, these are pretty simplistic. They got your principal and interest, which is just that, principal and interest based upon the loan interest rate on the amount financed. You got property taxes.
Sorry, just in case people don't know, principal is the amount that you're actually paying towards the loan.
That is correct.
Sorry, go
that
ahead.
is correct. Your property taxes are your homeowner's taxes. Your insurance is your insurance. And then your mortgage insurance is something that's commonly referred to as PMI, private mortgage insurance. And so within that, all of those, if you'll notice, all those strategies have one with the exclusion of VA. VA does not require a private mortgage monthly insurance, which is, again, sometimes a benefit of that particular loan program. The monthly payments are roughly the same. When I say, go ahead.
Sorry, I'm going to keep interjecting just to make sure.
No, please.
And so to clarify also, if someone were to put 20% down on conventional, they wouldn't have that as well. Or
you are correct. Yes. So then it goes down to, hey, if you end up putting the 20% down, the 2 PMIs on strategies 1 and 2 would go away. That is absolutely correct.
Perfect. Okay.
Okay. So that's kind of the payment breakdown of the loan, right? And so now the next thing that I think is always important to all of us, what is the cost of the loan to me? Okay, I understand the payment, I understand all of that. Now, what is the actual cost of the loan to me? And so we'll click on the closing cost tab here. And so what this will show you, right, is a couple of different things. And again, please interject, Alicia, you're doing great. Is it does confirm the amount of money down payment or the equity that you're buying into the home. And that's where you've got the 3% down on strategy 1 and the 5% down on strategy 2. Mm-hmm. If you'll notice, and again, not trying to muddy the water any bit here, is the FHA shows the 3.5% down, but it also shows you the loan to value, because on FHA loans, there is an increase of a 1.75% mortgage insurance financed back into the loan. Okay. And so that increases your loan to value, even though you put the down payment on there. So go ahead.
And that's all FHA?
That is for all FHA. So even if you go FHA with 5% down or FHA with 10% down, they're going to add an upfront mortgage insurance premium into that loan.
In addition to the monthly one that you pay.
That is correct. And the monthly one on that one, as we all know for FHA, is for the life of the loan. The VA piece, kind of, I should probably put an asterisk by here, but it's a good point, because there are an upfront funding fee on a VA loan unless the veteran is 20% disabled or greater, and typically they've got a funding fee that's exempt. Then they would not have that, and you would just see 100% loan on that component.
Got it.
The next little section here, I'm gonna divert a little bit from this slide at this point to just kind of answer this, because I know it's an important cost, important question is, well, my interest rate's this, but my APR is that. What in the heck is the APR, Rich? So at this point, I'm going to just kind of cover this over here. Does everybody see the PDF on that?
Yes.
So what is a mortgage APR? So first and foremost, APR stands for the annual percentage rate. Your credit cards have it, your automobiles have it, everything that we finance has some form of an APR. Mm-hmm. But what does it mean specific to my mortgage? And so I'll just read what the actual definition is, and hopefully that helps us. Mortgage APR is defined as the annualized cost of credit on a home loan. It is the interest rate that would produce the same monthly payment on your loan amount with no fees as you would pay it if you rolled all your fees into the loan itself.
Got it.
So typically how you can look at that is, well, I've got closing costs, I've got discounts, and we'll get into some of those lender credits and all of those. All those things play into effect in your APR. And so even though your interest rate is 3.25%, 3.5%, whatever it happens to be, your annual percentage rate is the cost of your loan rolled into the loan being financed, represented as an interest rate. So I know it's confusing. It's that's why we go and get the definition for it, just for the fact that there's a lot of information on there that it's like, well, wait a minute, then what is my true interest rate? And then that's where.
Can I interrupt you real fast?
Yes,
so
please.
You say that the APR then is kind of like the great equalizer. That's kind of the number that you would look at to say, with all fees included in this, it all comes into that APR. So that, is it the APR that we really want to be focused on as far as knowing the total cost that we'll be paying over the lifetime?
Absolutely, right? So I think what that is it's a lot of fees associated with the loan. Not all fees are equal, right?
Mhm.
Lender fees, for instance, might not all be the same if you're comparing two or three different lenders. The cost of the rate or the discount of the rate might
Mhm.
be different. There are, other things that fall in line with the loan might be different, right? And so you definitely want to take all of that into consideration and see what those are, to make
Okay.
sure that they make sense, right? Because like even if you look at the scenarios here, the APR costs are affected a little bit higher on the government type loans. Well, there's additional fees that are
Mhm.
charged on those loans that you don't get with conventional. Therefore, the conventional are a little bit less expensive.
Got it.
Okay, so as we go through there, neither of these loans, now we'll go back to kind of the closing cost scenario. I really hope to make some sense here, is what is the cost of the loan, right? And so what that means is there's no non-APR cost, but then there's something that is referred to as points or discounts. We just have it represented in this feed, kind of trying to be as clean and cut as possible as points. This is points to the interest rate. And so again, if I go back through here and I'll just close this out, remind everybody the interest rate tab here, right? Is you've got interest rates that range from 3.625 to 3.5.
Mhm.
That's what we're talking about in this section here of points. The particular one on the first strategy actually is giving a lender credit of $720.22. So that means they're not buying that rate down. Us as the lender, they will see a closing cost credit of $720 on their final closing disclosure. The points or cost of the other three are actually higher, right? So the strategy 2 is costing $18.29. And so there would be a loan discount on the closing disclosure for that, as well as discounts on the VA and FHA in this particular scenario that we ran of $2,300 or $3,700 based on the cost of that interest rate for the credit score that we utilized on our test case here.
So how are these figures calculated? Like what determines that one will cost this, one will cost that, one you get a discount here, so how is that determined?
Right. So it's a great question. So it's also it's built into kind of the criteria would be debt ratio, credit score. Credit score and debt ratio are going to be your two main drivers on that.
Okay.
Then depending on your equitable position, right, of kind of going through there, and I've already kind of lost what the interest rate was. So this interest rate that was costing $18 on strategy 2 is a quarter of a point less, even though it costs the borrowers benefiting from a 0.25% less interest rate monthly. And so, at that point is, hey, if I'm saving a 0.25% over the life of the loan, maybe it's worth me paying $18 for that rate.
And is it $18 a month?
No, that's part of the closing cost. So again, these are closing cost scenarios. It's a one-time fee. They pay it as a loan discount, and then they get the interest rate of 3.25%.
Got it.
Yeah, go ahead.
I was just saying, pretty good deal.
And no, absolutely, right? Because again, if you look back over to the other scenarios, is on the FHA and the VA strategies, those are higher cost, much higher cost in the VA scenario than what the conventional loan would have, as well as if they're not a disabled vet. I mean, they're adding $6,300 to their loan. And
Right.
that's where you start looking at the strategies. Okay, I'm a veteran. I don't have a disability associated with it. Holy cow, it's costing me, 10 grand extra over the life of the loan to get the discount rate, to get the closing cost scenario, to really look into that piece, right? And so that's when we start narrowing this down to what scenario makes the most sense to us.
Right. And
Okay.
like you said, it depends on if someone's like, well, I really can only afford this much per month,
Right.
then one would make more sense, even if over the lifetime of the loan you end up paying more. But if it means you can get into the house, fantastic. But if someone's goal is, I don't really care how much it costs me now, I, over the lifetime of the loan, want to pay as little as possible, this kind of helps, like you said, direct them to the right spot to make sure they're achieving what they're looking for.
Perfect segue right here, right? Because what I just said on the VA, if you actually go down to now my cash to close, we get this beautiful home. Alicia and Roland find it for us. We're ready to close. Now, what do I bring to the table to get my keys? Well, now we're opposite. The VA loan's the least amount out of your pocket because it's 100% financed. So now I can get into a $275,000 home in this scenario for $7,300. And, whereas if you look at strategies like 3 and 2, you're $17,000 on that, and that's where it kind of starts narrowing down is, okay, my cash to close in strategy 1's only $11,000 opposed to 73, but I get a conventional loan. I'm in an equitable position. I get the lender credit in that scenario. I think that makes the most sense to me, right? Or, hey, I've only got $8,000 to buy a home. The VA loan makes the most sense, and I'm fine with the payment.
Right.
Let's see here. Okay, so this kind of breaks down on and this is just so I didn't go too quick. I just click on the feed structure, right? It shows the point credit again, prepaid interest. Now, this is something that a lot of people, I don't know, really look into when they're given strategies, is what is the prepaid interest? Well, if I close on a loan, today's the 21st, right? So if I closed on the loan today, I have to pay interest from today through the end of the month because my first payment's not due till June 1st. And so that prepaid interest is something you're paying kind of upfront as closing cost, even though, your first payment's not due till June 1st.
Got it.
Okay. So, and in this situation, just to point out too, again, we didn't have a live contract. We didn't have a live buyer. So we didn't have earnest money or seller paid credits or things of that nature that would have handled in these little scenarios down here at the bottom as well.
Got it.
Let's see here. So this kind of, as we scroll through this, and again, this is through a presentation in a group that we use called Mortgage Coach. It's just hopefully to give them one scenario that looks a little bit different and kind of answers the questions for the clients as they go through it. And so as your total cash to close, it puts it in a nice little bar graph here for everybody, and they can say, hey, really, I'm kind of deciding between strategy 1 and strategy 4. Let's dive a little bit deeper into those.
Got it.
Let's see what this kind of looks at. This is kind of a reinvestment strategy. I will say you want to actually put some more information in here than we did in this scenario again, right? It does kind of break it down into savings monthly and your PITI, right? So this is your principal, interest, taxes, and insurance, and it gives it to you on all. And again, just to kind of reiterate what we talked about a little while ago, that is everything. That's your principal, that's your interest, that's your taxes, that's your insurance. This is your monthly mortgage payment as we look into that, right? And so the estimated years of MI cutoff, and again, this is probably on quote unquote averages, not necessarily maybe what it is, but it's based on the private mortgage insurance falling off at 9 years, 8 years, or as we've said, is the FHA is for the life of the loan. And the life of the loan states for a purchase or sell or refinance out of an FHA for that to go away.
And I think that's important for people to realize, because I know I've talked with a lot of people who are insistent on, no, I really want to pay my 20% down so that I don't have this, because they're worried that this payment's going to be there forever. But it's important to remember that with conventional, that does eventually fall off. So if you're not able to come up with the 20%, but don't want that, is important to know that that's not going to last forever.
No,
But
absolutely.
okay.
And sometimes, just so we can talk a little bit even with that, is if a client is extremely adamant on doing a conventional loan, we would give them strategies across the board that are all conventional, of like a 3%, a 5%, a 10%, and a 20%. So then
Perfect.
they have all four of those strategies, so they can look at it and say, oh, wow, saved myself $25,000 and it only really affects my payment X. I would rather keep my cash to close because of the craziness of this world that we're in right now, anyways, right? So,
I like being able to see all of those straight out in front of you where you can really make an informed decision, not just
absolutely.
now, but for years to come. That's
Right.
helpful.
Right, absolutely. And as we deal with first-time home buyers and individuals that do the move up or move down homes, that's really important for them to see that as well.
Perfect.
As we got into the client speaking and things of that nature, we would get into, a savings rate or an investment balance. Again, using a scenario of 3, 10, 5, 20% down, we could get into some reinvestment strategies for them there of what they could do better with that money that might ultimately, save them more than what the cost of the PMI would be over the life of the loan as well.
Perfect.
So once they kind of go through that, at that point, right, they end up making an informed decision of, okay, Rich, we want to go through and purchase the home with Alicia, and we want to do the 5% down. And at that point, we will get you an approval letter that states that. And so I think at that time, unless we have any other questions on there, I'll stop sharing my screen and we'll kind of go back to the split screen here and answer any other additional questions that we might have.
Perfect. I know, let me check. I know there are things I want to make sure we covered. Let's see. I think we covered everything that I wanted to make sure we covered during that section. I think another one that I just thought of as you were talking just now is, so if someone decides that they would like to go with one of the options that you presented, but then before we close, they decide, oh wait, never mind, I actually want to do this much down, or I want to hold on to that. How does it affect underwriting and all that to switch it mid process?
There comes a time that it would cause a concern, but for the most part, the challenges for us is if we go VA, for instance, and we switch to conventional. Well, now I've got a VA appraisal that's very specific to the VA that I've got to convert to a conventional, or vice versa. We decide to go conventional, and then it's like, wait a minute. I found out I am a disabled vet, and I don't have the funding fee and things of that nature. And so let's go VA. The challenges for us is typically switching an appraisal to match the loan. As far as different down payments and all of that sort of stuff, believe it or not, we have a lot of clients that come through saying, hey, I want to put 20% down. I don't want any PMI. And then as they think about it and work through that, they end up deciding to put less money down and dealing with the PMI because they find out it's so less expensive than what they thought.
Got it. And then is there anything that I know that for a long time, everyone was pushing that it's easier to get into an FHA loan. If you have poor credit, then FHA is the way to go. But it seems like lately that hasn't really been the case anymore. Are you seeing that more so people are moving towards conventional? Because even in your write-up, like conventional was obviously clearly the better choice,
right,
as far as payments and overall. But what are you seeing?
Great question. And so I'm a little hesitant to answer specifically because every client is unique, right? And so what I would say as consumer, weigh your options to what's best for you as the consumer. I don't think a lender nor any other person, even your neighbors, like, oh, hey, I got this rate and I did this and man, it was great. And then they come to you and they don't fit into that box. And then it's like, well, wait a minute, why do I not fit into it, right? The FHA loan has been an incredible tool, is an incredible tool for clients. currently, as the structure sets with our current state of economy, the FHA loan is a little bit more difficult to get approved for. They're putting a little extra additional requirements on them. A lot of lenders, including ourselves, have increased the credit score requirement of the FHA loan. So again, that's why I put these strategies out to them. If you've got a decent credit score and can have the option of 3% down or 3.5% down, what's the value of it? I say less money down is the value of it, right? FHA in the past, and not so much right now, but in the past had been a little bit more liberal on debt ratio and things of that nature. They've kind of tightened that back down. So again, I never want to make that decision just broadly. I'd like to talk to the clients to understand what their goals are.
Right. No, that's perfect. That's really interesting to hear that the just changes that have happened recently with the criteria that they're requesting.
Well, the two questions that we've been asked the most in the last I guess it's 6 weeks is, hey, the Fed dropped the interest rate to 0. Do I get a 0% interest rate? No. as much as we would like to, the answer is no. The Fed rate truly doesn't have anything day in, day out to do with mortgage rates. The mortgage rates are mortgage 10-year treasury. It changes daily as the economy changes. And sometimes good, bad, indifferent, we get changes based on what the stock market's doing, not what the Fed's doing at all. So know that I posted something on LinkedIn or Facebook earlier today talking about in 1985, like the average mortgage rate was 11, 12, 14%, something like that.
Wow. So
just to remind us, you can still get a loan in less than 4% is pretty incredible.
Pretty incredible.
Because I guarantee you we've got a lot of parents and grandparents out there that would have told you in the mid 80s there was no way that would ever happen. And so I think we have to take that into consideration, right? I don't know if that kind of answered.
Yeah, no, that's helpful. And so the strategies that you kind of showed us today, all of those would you'd be able to do a similar thing if someone were looking to refinance as well?
Absolutely, yeah. So what we do with that, with the equity and things of that nature in their home, we're able to kind of give them that sort of stuff of, hey, refinance, lower term, lower rate. Here's what it would mean to you. That's something that absolutely can be done. And I think ultimately what our goal is in that presentation is too often we see, hey, Rich, can you beat this rate, this fees, this whatever? And a lot of lenders just send the one page, I classify dumbed down mortgage of like this. Didn't really put a lot of effort and work into it. Our goal, as you and I've talked about, even within the clients that we've worked with, we want them having family time, and especially in this quarantine life, you want to love your home, love your situation. And I would tell you the only thing that we're kind of tied to is we want to make sure that you have the ability to repay your loan so you don't lose that home. That is so important to you as the buyer, and it's important to your community. If you live in a community that all of a sudden has a bunch of foreclosures or this or that, it's something you want to be aware of. And my last statement, just to kind of tie in with the refinance piece, is when you get from your current lender, hey, forbearance, or hey, missed some payments, or all of that sort of stuff, talk to somebody that's in the industry, because I think sometimes they're not as what sounds good today might hurt you tomorrow. And a lot of the forbearances that we've seen, for instance, said, hey, missed 2 or 3 payments, but then in month 4 or month 5, every payment's due. And so my argument is, if, in these situations, I think they were all sub $2,000 house payments. If you can't make the $2,000 house payment one month, how are you going to make $8,000 in month 4? So talk to your loan officer, talk to your current servicer, and really, we're all in this together. We've seen that all over town, hashtag all in together we win, all that sort of stuff. Look at that and reach out to the experts to kind of help you on that.
No, I agree completely. I mean, banks are not in the market to foreclose. They are not in the real estate market. They don't want homes.
Right, right.
So their goal is to help people make their payments. So from my experience, banks are usually pretty good about
Right.
helping out as much as they can to make sure someone
Right.
saves their home. So, but no, I agree with that, because I always tell my clients, I'm like, I want you comfortable
Right.
with your payment. I don't want you house poor. I don't want you so stressed out and strapped because
Right.
you over leveraged yourself. And so I think understanding these quotes and what it means, not just in your monthly payments, but the long-term course of things, I think is just so empowering. So
Oh,
thank you
absolutely.
so much for sharing that with us. And if anyone has any more further questions, we have Rich's contact information down at the bottom. So feel free to reach out to him. Let him know if you have any specific questions. I'm sure he'd be happy to
Oh, absolutely.
answer them for you. So thanks again, Rich. We really
Oh, you're
appreciate
great.
having you here and sharing your wisdom with us.
No, I appreciate the opportunity, and you guys stay safe out there. Okay.
You too. Thank you.
All right. We'll talk soon.
Bye-bye.